Hello, good evening, everyone. A very warm welcome to you, and thanks for coming to attend our OTCS Market Outlook 2022. How time flies, right? So, my name is Richard, and I'll be your host for tonight. And thank you for coming. And today, the Market Outlook is made possible with the support of the following friends that we have. Firstly is OTCS, which is the organizer for tonight. So the second one is Wealth and Joy. Third is my stocksinvesting.com. Fourth is wealthlions.com. Fifth is usavvy.com. And last but not least is IHS Markit. So if you'd like to check out and be kept posted of what each of these friends are doing, please join the respective Telegram channels that you see on the screen or visit the website. Okay, without further ado, let me now continue. Now, how is the market? Right? So if you've been following the US S&P 500, you probably would have seen something like this, right? In the last couple of days. Some people say that the market will take a stairs up and jump off a cliff. So what do you think? Yesterday, it jumped off a cliff and jumped up staircase also. So what does this all mean, right? So let's take a zoom out and take a look at a bigger picture. Now, this is like a 1 year chart, and you can see that the market has been going up and up and up and up. And then in somewhere in September, it hit a curb and it gotten volatile. But nevertheless, it still made higher high and higher low. So the uptrend is still intact and the S&P was moving in an uptrend channel. Then all of a sudden, in the last couple of weeks, it fell out of it, right? And then it had a 7% drop from the all-time high. Now, what is this called? Uh, I don't know what you call it, but it is very volatile to me, right? So it has broken two support levels in just 1 week. And we are now hairline away from the third support level. So the uptrend in S&P is officially broken. So now where do we go from here? Right? So I am not the expert. I couldn't read the tea leaf, but one of the other indicator that I kept watch is this thing called the VIX term structure. So yeah, you can Google it and find out what is it all about. Now, in the normal times when the market is behaving normally with its small corrections, you will see that the VIX term structure curves upwards, like what you're seeing on the screen right now. Right? So when this curve is curving upwards, I don't expect very major things to happen in the market. Right? Some people can even buy the dips and it should still be okay. However, whenever this curve bends downwards, like what you see on the screen right now, then it's a different story. What you see earlier was called contango when it's curving upwards. But right now, what you see is called backwardation. So when the VIX term structure is curving downwards, which is called backwardation, there is great fear in the market. Right? So the market will be very volatile and it will swing up and down. So you will have to check your trade plan or investment plan to see what you want to do, right? Some people will take these opportunities to fish for value stocks because they probably would have dropped. If you look at Microsoft, you look at Google, maybe you even look at Netflix, if you consider it a value or growth stock, they have dropped by quite a bit. And some people, they will be buying the dip whenever they see the VIX term structure go into backwardation. But this is not investment advice. You do your own diligence. And today we're going to hear it from three experts. Okay. So how is the market? To me, it is just simply very, very volatile. So please uh, trade and invest carefully. All right. So now let me now move on to share with you a little bit about the organizer, Online Traders Club Singapore, and what we are about. Now, OTCS, which stands for Online Traders Club Singapore, is a non-profit society set up in 2005, and we are a community of traders and investors run totally by volunteers. And to me, OTCS stands for a place where we network, share, and learn. And we do it through a series of workshops, such as the webinar you're attending right now, courses, and our library. Now, for workshops, we aim to have about 10 to 12 a year. And it is free for our members to attend. However, since COVID, and we have moved entirely online, so we are making it available to everyone for free. So please enjoy and take advantage of it. All right. So this was one of the last in-person events that we had back in 2020 that we held in SGX Auditorium. It was very well received, and thanks to SGX for their sponsorship of the auditorium for us to use. And I look forward to be able to have events like this in person, hopefully in a not too distant future. As for courses, we aim to have 3 to 6 a year. Essentially, we will approach trainers and we'll do a group buy with the trainer to get the courses at a better price for our members. As for our library, we have over $6,000 worth of resources that our members can borrow. However, our library is currently closed because of COVID. But if you want to know what are the resources, you can get the list from our website, onlinetradersclub.org. Now, again, OTCS is a place where we network, share, and learn, and we do it through a series of workshops, courses, and our library. So the next question is, how much? Now, the normal price to join as a member is $120 a year. However, for a time limited period, it is $60 a year. All right. And however, because of COVID, it is currently free for everyone. All right. So to find out more about our activities and how to join, please visit onlinetradersclub.org. And if you would like to be kept posted of our events, please join our Telegram channel. Search for Online Traders Club in Telegram and join it. It is a channel, so it's not a group chat, so it will not be noisy. Alternatively, you can join our mailing list by submitting your email at the website on our website. And at this point, I'd like to give a shout out to our unsung hero who helps us behind the scenes when we run physical events. And that's our friends and also fellow members of OTCS. And we call them our OTCS crew. Thank you for all your support whenever we run our physical events. All right. Thank you. And very importantly is the disclaimer. Now, you are responsible for your own profits and losses. The speaker's opinions are their own and does not represent OTCS opinions. OTCS is office holders, associates, sponsors are not responsible nor liable for your losses. And OTCS events are for educational purposes only and should not be construed as advice. And when you're in doubt, please seek professional help. Now, with that out of the way, we can go into the main topic for today, which is the market outlook. Now, as you know, the market went on very nicely, making all-time high, and then suddenly we enter into a storm. So where do we go from here? Right? So tonight, it is my privilege and honor to have invited three expert practitioners in their respective fields to share with us their insights. And the first is will be shared by Ms. Pan Jingyi, who is a Associate Economics Director from IHS Markit, a listed US listed firm. And it is my pleasure to hand the mic over to Jingyi to share with us her insights and views about the global markets in 2020. Jingyi, over to you.
Hi. Thanks, Richard. Just to check, can you hear me?
Yes,
And I'll proceed to share my screen. While I actually want to thank Richard again for inviting me back to this. So I think the last time we did this was like the start of 2021. Things have changed a lot, myself including in a new role that's a little bit more I would say economic space, but definitely I think there's a lot of interesting things that I'm going to bring to you about, particularly when it comes to looking at the global market into this year. So I think my screen is starting to show. Maybe Richard can help me confirm that it is showing before I proceed.
it is saying screen loading. We can hear and see you clearly. Did it prompt you for permission?
And I think it says you're now sharing, but as you say, technology.
Ah,
Yeah.
okay, we gotta give it a little bit more time. It still says loading.
Okay. Okay.
Hmm.
Maybe I'll just
Yes, it's out.
Okay, that's wonderful. Okay, so maybe I'll just begin. And again, and I want to thank Richard for this session that I get to share about this again. As Richard said, with IHS Market, it may not be something that's perhaps familiar to a lot of retail traders. That a lot of the my audience in the past when I was with another broker, Rach, in my previous firm. But definitely, what we do here itself actually provides information to a lot of, I would say, institutional sides of things and even to central banks themselves. So I think the information itself, I think it's something that's very cutting edge in terms of just looking at a lot of the leading stuff that we have. And I think today I'm going to bring that to you. So that really combines some of our top economic predictions for 2022. And at the same time, that's been well backed to some extent by what we're seeing from the PMI data side of things. Some of us may be familiar with the PMI, but if not, don't worry, I'll go through them. And I think, there's a wealth of information that'll be helpful for you in looking at the markets in this very strange new year. So with that being said, let me move on to the next slide. Think it takes like a little bit of a lag, so bear with me, when it takes time to change. So a little bit about myself. My name is Jingyi, Economics Associate Director at IHS Markit. What my background is in is both economics and finance, so definitely quite a lot. I think I could share with you today on that. So to start with, I think I really like to frame the conversation a little bit, and that's really just because I think what's important is we want to address some of the key issues that we are seeing into 2022. And interestingly, I got this from one of the Bloomberg posts that actually goes on to share. So this is a poll of their market professionals for 2022, taken at the turn of the year. And you can see, well, actually what's not too different for 2022 is that the rise of inflation, COVID-19 continue to be among the top concerns for market professionals. And today we'll be talking about that quite a lot as well. As mentioned, we're going to start a little bit talking about what's the situation like. But I want to just really share a little bit about the PMI data because that is what, at the heart we do. And that is one, I would say, of the first economic indicator that you can get every month when it comes to looking at different economies, different markets, and segregating them by sectors as well. These are the kind of wealth of information that the PMI data that we bring. So to start with, we look at the PMI coverage itself. Everything in green here being covered by us, and you can see that that's a vast number of countries around the world. Around 90% of the global GDP, in fact, is being covered to that extent, and that every month we are actually interviewing about 30,000 companies to bring you the kind of data that you see. Now, I think at the heart of why we create the data, this PMI data that is being so sought after around the world, is because we want to better inform everyone, whether you are someone who is person on the street, investor like yourself and I, or someone who is in, say, even the World Bank, and these are the people who look at our data to make a lot of their economic investment decisions as well for the funds, institutional investors. So what we see with a lot of the official economic indicators is that sometimes there's a lot of inconsistent methodologies, and you can see that market react to the release of this data because these data itself are also well subjected to a lot of ongoing revisions, and so on and so forth, and the infrequent release. So after the market thinking that economy is doing well, but later on to find out that isn't the case, I think that's kind of knee-jerk reaction that you see. And then that's why with the PMI survey, it's something that's independent, it's something that's privately done, and really giving you the most, I would say, earliest indication of the data to start with.
Jingyi,
Mhm.
yeah, maybe you can share with us what does PMI stand for?
I am sorry. Yes. So thank you, Richard. So PMI, as the name itself abbreviates, it means Purchasing Managers Index, which in other words means is a index that we have created through asking purchasing managers in companies. Of course, the origin of it begins with looking at the manufacturing sector in particular, dating back in the days to the likes of the ISM, pre-ISM days itself. That's how the data itself was pretty much constructed, looking into the different, indications from the purchasing manager. So the surveys are something that's been sent to them. So in other words, you are getting, the indication of how the economy is doing from the horse's mouth. So I hope that answers your question. But like Richard say, anything else, please post them and I'll be happy to take them towards the end of this webinar itself as well. So how we have created the webinar and why people look at it, over here to the right side, you can see that we have the China manufacturing PMI panel. I think what's really important is not only are the sectors well represented in accordance to how that is contributing to the GDP accounting, say for manufacturing, they are also divided into small, medium, and large enterprises in terms of their contribution to GDP. So it is, in other words, a very well represented data to measure the economic conditions for the particular country and sector that it is looking at. There's no trade association associated with this, so it's very fair data, I would say. And I think a lot of people see it as surveys, so they think of it as sentiment. That's not the case, because when we ask these purchasing managers, so for example, do you see output having increased or decreased from the previous month in the questionnaire, these people are actually taking out their order books and actually comparing the numbers and giving us hard data. So what you are seeing is in fact hard data. And I think a lot of us, when it comes to China's manufacturing PMI, this is one of the perhaps most followed one around the world. But of course, I think in the Eurozone, it's very popular as well. And for a lot of APAC countries that doesn't have, too much of this high frequency data, they do rely on what we have. So when you hear something about contraction, expansion, that number itself, and then you see it's around 50. So what happens is that these data itself is actually being asked to the panel, and then for example, one person might say that it went on higher, so that is actually creating a number of one lower zero, as you can see here. So it creates a diffusion index. So 50 is largely neutral, anything above is growing and otherwise decreasing. And to the left, you can see that, we do normally only see the manufacturing and service, and therefore the composite PMI that's been posted online. What's beneath it is actually a very huge array of sub indices, which today I will share with you what are the latest findings and how that is quite important in telling us signals about the economy. So as I said, there are three different types of panel for our country data: manufacturing, services, and also the composite indices. So without further ado, I'm going to move on to the top economic predictions that we have by IHS Markit for 2022 and the corresponding economic signals derived from our surveys. So I would like to start with actually the first and foremost. It's quite interesting. This, I think, we have had in enough, more than enough of talking about COVID, but it's not going to stop with the turn of the year. In fact, there's just going to be more going on to 2022. But what I think, is bit of a change in view that which we hold when it comes to the COVID-19 situation is that we are not actually going to see this derailing the economic recovery as it transition from a state of being pandemic to endemic status. I think in Singapore we are very familiar with it, and in fact I think the legislation or the rules themselves are pretty much accommodating to this kind of change as well. But what we are saying is that on a global scale, this is expected to continue. And why is this so? Let me just explain it a little bit before I get into the data side of things. I think to a lot of us that what we have been seeing is two perhaps primary concerns for governments. One is avoiding the kind of stress onto the health system, and the second being really encouraging vaccinations because that helps to lower the kind of stress on the health system itself. And I think what we have been seeing so far is things moving in a bit of a positive trend, even as the Omicron variant was seen hitting many parts of the world, here in Singapore as well. So that seems to be the case, and we do not expect future variants to perhaps play a different part as well. So to go on to show what I've been talking about, what we have observed from our factory output growth data on the left here. So this is a chart that we have put together in the June-July period of 2021 last year. I think that was the period of time that we have seen the Delta wave really hitting the global economy, especially I would say maybe for APAC, that it was seen to be a little bit worse than our Western counterparts. And why is that so? If you draw the line of best fit, the green line over here, you can see that this actually had been the case where the manufacturing output is lower in a country where vaccination rate is much lower than 50, and the economies that are actually seeing vaccination rates above 50%, these are the ones that have been growing. But moving fast forward to right now, turn of the year into 2022, in January 11th, when I took the data from our world data here to the right chart, you can see that most of us, at least the key countries that we do track, whether you are perhaps trading the FX market or indices, these are the guys who are actually doing better than the world vaccination rate on average, at least for one dose, that's been seen. And I think that is itself a testimony to things are taking a little bit better turn moving forward. We look at the PMI data itself, it's pretty much so on the left chart over here. Let me just caveat as well that a lot of data as of right now, it's updated till December. I think we are in what I call the turn of the month period for PMI data, because yesterday we just got all the flash numbers for some of the developed countries, which I'll share some with you. But these all will get updated on the first working day of the month. So January data will be out very soon next year during Chinese New Year. So definitely something interesting to look at. But for what we have in December right now, what we have seen is that certainly in terms of the containment index, the orange bars, things have taken a little bit of a worse turn, and we're not surprised in the likes of Europe, particularly. There's more caution that been seen. And, in Japan, if you recall, they have also stopped foreign travels, for that matter, foreigners entering. So there's a bit of an increase in terms of the containment measures. But what you do find is that manufacturing growth had in fact still continued to improve. But on the other hand, services are the ones that's been hit pretty bad. So I think, yes, certainly for services, they are not going to be immune to what we are seeing, but the likes of manufacturers, they are better adapting to the kind of different waves that we are seeing with the COVID-19 situation, and people are generally trying to live with this situation. Likewise, when we come to the sector data, you can find that this is very distinctively being displayed over here, that the bottom of the left bars, that you have tourism and recreation that's been seen hit, but towards the top of which, healthcare, all of these guys are doing pretty well, still continuing to grow for the most of the sectors that we track in the global output situation. So as I mentioned, we do have the flash data that was just out of the stove yesterday. Quite a bit of an interesting situation over here. Now, I think what's important to highlight is that December data for us is taken in the early part of the month, because towards the second half of the month, most of us are clearing leave, so there's not a lot of people around. So you can think of that the data itself is also capturing the early part of the Omicron variant's hit to the global economy. Whereas in January, at this point of time, I think those for the likes of Australia, they've certainly seen the situation worsening and in fact turning a little bit better at this point of time as we talk as well. So really capturing the kind of differences that you can see over here. So with the Omicron hit to many of these developed countries that you can see, the fact is that the UK had interestingly exhibited quite a bit of resilience when it comes to their composite output. So this is the composite output index, whereas for the likes of Australia, things have taken quite a bit of a steep turn. When below 50, if you recall, that is actually contractionary state. And while I would say, all of this is important, towards the end, I will just bring you as well a little bit towards the link that you could actually derive some of important signals from the PMI in terms of trading for the FX and also equity market as well. So that is our flash PMI data indications for January. But moving on, I'll go on to the second important point that we continue to look at, which is supply chain challenges. These are, however, expected to continue disrupt key industries. But we do see that the upward pressure on prices will actually ease, although that may be into the second half of 2022. So first half of 2022, I think, yesterday we have the Singapore CPI that perhaps came as a bit of a surprise for us. So that kind of surprising data, I think that's going to keep its, plays around for a bit, at least into the first half of the year, before things ease into the second half of 2022 based on expectations. I think what we're seeing, a lot of these kind of bottlenecks, they are still in a very severe state. So we'll look at how that is translating to our situation. So first and foremost, I think, we had some of these good news coming through already from the Delta wave easing for Asia Pacific economies. So, to a large extent, things have taken a bit of a worse turn towards the latter half of 2021. But things have actually picked up into the end of the year. And that, as we know, for APAC economies is due to the fact that the Delta wave had affected us, that had eased in many of the production areas. So you think about the likes of Vietnam, Thailand, Indonesia, and so on and so forth. And I think that being said, what's really interesting about the data as well is that you could actually mix and match with the sub indices. So over here, what I'm showing you here with the gray line, the gray bar on the top left chart here, is new orders. So think of it as demand. And then the thinner green line that seems to be overlapping it is output. So for greater part of history, as it seems over there, new orders and output, so demand and production, pretty much moved in tandem. But in the last year itself, you can see that there had been a little bit of a gap when demand itself continued to grow at a slower pace. Output itself had actually been produced growing at a much slower pace. So if you take the difference over here, you can see that this itself is saying that demand is actually growing at a faster rate than output. And why is that the case? So really not a surprise again here, due to the fact that we're seeing supply issues plaguing a lot of the different countries. But what's been positive, at least into the end of 2021, is the fact that in December itself, these data, as I said, is dated up to December 2021. Output itself had in fact improved a little bit, and that itself is going to show that demand issue seems to be easing a little bit into the end of the year. And you can do this across the different countries as well to see where things are improving. Obviously, in Asia, where the hub of manufacturing is, that's doing a lot better than the West. But at the same time, it doesn't mean that backlogs have actually improved. So we have a backlogs of work index that's likewise showing some pressure over here. And that, as we know, is due to the fact that suppliers' delivery time across the world continue to be something that is very much very severe. So here I have a chart that's dated till December once again. You can see that the fact is over in the likes of the US, so the thick green line over here, the likes of Eurozone, people are in fact seeing the situation into the 2021 much worse than when the pandemic first hit them in 2020. So a lot of the situation have actually snowballed, and that caused a lot of the severe issues that you're seeing. I think we know that Apple is going to be one releasing their earnings into the end of this week, and they cited supply chain issues. So this is the kind of data that's going on to show you how severe they might be seeing it. But that being said, things are actually improving a little bit into the end of last year, which I think is something that we see as a positive sign. But of course, before the Omicron variant hit as well. So like I said, I'd like to update you with the latest, so the flash PMI data. Again, just let me highlight to you, earlier we talked about official data having revisions. Why we have a flash and a final data is that the data collection process goes through a couple of days when people do come in with the result. So the flash data, in fact, captures about 85% of the respondents' answers, before the final data is 100% of the panel's response. So it is not revised, it is just a smaller proportion of it, but it gives a very strong indication of what the final data is going to be for the PMI. So over here, you can see that with the IHS Markit Flash PMI, sorry that I didn't put a header over here, but it actually goes on to show the supplier's delivery time. And you can see that, in fact, the UK again have been the one to show resilience, but for the likes of, US and Australia, obviously we know that they had quite a bit of a situation with the COVID-19 Omicron variant. These are the ones that have actually seen their suppliers delivery time lengthen at a much more severe rate into the start of this year. But the situation itself, I should have to highlight that the situation itself is still perhaps not as severe as the key depth in 2021 itself. So despite the hit itself, I think that we are seeing it's not as bad. So coming back to quite a bit of an interesting trend that we observe from comments, global companies themselves, when it comes to reporting the shortages of input, while it's still at many, many times of the survey average, which is one, this itself still is coming down a little bit into the end of last year, which is a positive sign. Semiconductor situation, we know that it's very, very crucial for automobile industries and so on and so forth. That's likewise easing as well. So the situation seems to be improving, but albeit within a state of, still severe situation. And we have this data, of course, cutting across some of the different sectors. And you can see that towards the bottom of the left chart, technology, equipment, industrial goods, these are the guys that are still not seeing their delay situation improving much significantly in December itself. And that, for a lot of us making investment decisions, coming through to calculate earnings, I think are important things to consider. So why did this happen? I think what's been interesting that our PMI team had discovered throughout the past couple of years of severe economic turmoil, I can say, and in last year in particular as well, when it comes to how the situation have worsened for supplier, and also on and so forth, is that a lot of people are actually, so think about it. I like to use a very bad analogy, but in Singapore, we had the situation where toilet papers were running out from around the shelves itself, and a lot of people's mentality is, I perhaps need to stock up a little bit more just in case, I'm not able to buy any more toilet paper. So imagine the same kind of mentality happening on a worldwide scale. And that's why the situation when it comes to this whole supply chain issues have been worsened, companies themselves generally see the importance to build safety stocks. So just safeguard against shortages or mitigate against increase in demand. When things recover, they do see that why not buy more now, and that is the situation that has aggravated the supply chain issues. Although good news again, on the right chart here, you can see that kind of report actually is seemingly to be easing a little bit. And in turn, a lot of the problems when it comes to having supply, early supply issues, is that it created price pressures. But what we're seeing, as that itself eased, the price pressure itself into the end of last year had evidently seemed to ease from the recent peak itself. Now, I can't say that for the US, for example, and I'll give you the link towards the end to read more about it from our flash data. Just because of what we're seeing in the short term due to the Omicron variant hit to. But then, that being said, I think overall, as the supply chain issues ease into 2022, which is our expectation, that itself is going to put lower price pressures in general, which should be good news to us, especially as as we think a lot about monetary policy moving forward. So you can see over here that a lot of the producers are seeing a lot of high costs, and that itself is more severe than how much they are actually passing on to clients altogether. So there is potential, for things to rise further if the input costs continue to be on the rise. Cutting across, we think about this a lot in terms of goods as well, but what's happening in the real world is that not only manufacturing are seeing this as well. Service firms are likewise charging more for their services, for the matter, whether this is due to the fact that their input materials are increasing, or even wages. So that's something to really contend with as well. So pretty much seeing that across many of the developed countries, but it looks like inflation rates have been peaking. So a little bit of a positive news perhaps that we could glean from the December data, but of course watching the Omicron variant developments. And likewise by sectors. Now, just to highlight as well what's been really backing the kind of view that we have when it comes to whether things are going to take a positive turn into the end of the year. That's gleaning from our investment managers index. So you can see over here, and that most of our money managers are in fact looking at the supply chain situation increasing. So all the bars itself, you can see that it's actually pointing to the Q3, Q4, which is second half of 2022, and I'll share more about this towards the end. So another point I think that brings us to, given what I've said so far, is the fact that central banks will continue monetary policy tightening, that we already know. I think Fed is going to be something to look at this week, and in turn we also see a lot of fiscal tightening worldwide. So to bring that home, what that means with the PMI data is that typically when the PMI itself, in this case I'm showing you what we have with the US, so when the PMI itself generally head above that kind of average, long-term average rate here, you can see that also translates to the Federal Reserve actually tightening their policy. And at this point of time, actually the data seems to be suggesting it's a little bit long overdue for the Fed to move along. So what's coming along at this point of time isn't a surprise. Likewise with the Bank of England, we know they've already moved ahead, but things appear to be easing a little bit. So it's going to be important to watch their next move. The ECB themselves perhaps hasn't moved so much. So, that's also an interesting one. So very quickly, one more point over here, we have the fact that the global expansion will actually diverge as well. So, earlier we talked about easing monetary policy, easing supply chain situation. So that itself is going to be happening quite unevenly across regions. Places that actually see the supply chain issues improving, these are going to be the guys that are going to benefit a lot more, and therefore should be the area and the kind of sectors that you look at into your investment into the new year. But vice versa, for those that are still caught behind, it's going to be important to look at that kind of differentiation. So some of the differentiation ways that you can look at it is developed versus emerging market. Developed world still seem to be doing well. You can compare as well across the different developed countries. You can compare across the emerging countries. And as I said, this has so far been the flash market data. So as I said, we're going to have the upcoming January data for worldwide PMI that's going to be out very soon from the 1st of February. But very quickly, if I still have time, Richard, I just really want to go through quickly why I think the PMI is very important for you and that kind of comparison that you should have with financial markets. So I think one way to look at the US dollar, for example, over here is in terms of how the PMI and the US dollar itself is moving. So you do see that the USD to a large extent is driven by how the yield movement is, for example. But during times when PMI is showing sharp downturn, such as during the pandemic situation, what happened when it came to the US dollar index is that it acted as a safe haven. And that kind of reaction that has been seen is quite apparent. So something to consider. And another research paper that our team have actually put together recently, and very importantly, I think, for short-term FX traders, is how the comparing the different differentials between the Euro USD in our example over here, but between two different countries PMI, and therefore their currency exchange over here. You can see that it actually provides a short-term signal as to what it should be the fair value. So I have left the link over here if you want to have a further read, but really on a very eye-level comparison here using the British pound and the euro, you can see that that kind of link is pretty clear. And that is not just, on a month-to-month basis, it's actually giving you a pretty, early signal as well. And likewise, with the global PMI and equity market data, what we see when it comes to the PMI, and here being comparison, we are using the FTSE All World Index. Likewise, you can see that it creates that kind of correlation with the data itself in terms of telling you how things are moving. So another example, frankly, we have a lot of them, so I will leave the link for you to take a look later on at your own free time if you should be interested in. But in terms of equity investing as well, just looking at the emerging versus developed market, likewise using the PMI for equity investing, you do find that that is able to give you early momentum signal in terms of how you should allocate your capital in order to beat the market. And here we have an investment strategy just looking at the PMI and using the sector US sector data, and you can see that likewise that's been the case with active win percentage about by saying it's a win percentage, and that is beating the passive market over here by quite a high percentage of over 50, around 55%, as you can see. So interesting things. Now, another thing that I mentioned is in terms of the investment managers index. So that itself is something that we have developed, and it actually us institutional investors, about 100 of them, with approximately 845 billion in terms of AUM, that's in US dollar. So that provides you the kind of data that looks at the US equity markets. And so far, I would say the data itself is showing pretty promising movements between that with our risk appetite index and the S&P, for example, if you look at the likes of the VIX. So if you should be interested in that. Now, of course, I think what we have a lot of time is actually institutional investors that may be interested in this, but definitely, to the left here, here we have on the first link. In terms of our research, we publish a lot of our papers and more of these macro ideas on the first link. But the second link, the press release, actually has this investment manager index as well every month to give you a picture as to what institutional investors may be looking at. So I really hope that all of what I've shared so far is going to be quite helpful for you in this volatile year, as Richard have mentioned. And I'll be happy to take any questions at this point of time.
Wow. Thanks, Jingyi. That has been a very intensive uh 50 over slides that you've just shared with us about PMI. Yeah, so let me just let the attendees know that if you have questions for Jingyi, please type into the chat box that you see on the bottom right corner of your device if you're using a desktop browser. And if you are using a mobile device, then you can use, you probably have to scroll up or down to look for the text box, right? So I don't know about the rest of the attendees, but for me, I am definitely a noob when it comes to PMI. I don't even know what it stands for. That's why I asked you. Yeah. So I think this is a very good intro overview for our attendees, for those who noobs like me, to have an idea that there is this index that is uh, professionally compiled by asking like 30,000 companies around the world, right? And then you compile the number. So can I, ask whether is it correct to say that if it's above zero and is rising means that the economy is likely to be improving? Is that how I should interpret the index?
So well, to explain, I think that would actually not be the case. It will actually be 50. So as
Oh,
mentioned, it's a
50. Okay.
diffusion index itself. So pretty much that is showing the so I may not be able to flip the slides in time, but pretty much going anything above 50 is showing that it's expanding. Anything below 50 is actually that it's contracting. So the turning points is actually very important for us to look at when it comes to the market. I think very often that's when you see that people are reacting. So for example, when it comes to a lot of countries that may be suddenly contracting, that's when you see the market reacting, the FX market reacting as well to how the data itself is showing that contraction being something of concern.
Ah, the turning point. Okay, understand. So where can retail investors like us look for this PMI?
Yeah. So to the left here, you can see that to the second link. So the public press release, the press release website has a calendar that tells you all the date. So definitely at the very first moment that the data is out, we will be on this website. But frankly, I think a lot of the global news channels, all your major news, finance news, I think even our local news, they will be covering this data as well. So it's something that it's followed very closely across the financial market.
Right, right, right. So in a nutshell, is for retail investors is to perhaps pay attention to that link, the second link on the page right now, and then whenever we see a turning point, and we can kind of have a rough idea of where the economy might be heading.
Yeah.
Correct? Okay,
Yeah.
wonderful. So let me see whether there any question.
Yeah. And while you
Okay.
look, I just really earlier I point out the point is when you look at say a market, really make the kind of comparison between two different countries. So just now we use Euro and USD, but it really is looking at maybe the Eurozone market versus the US market. If you see one doing a lot better than the other, I think that's where you know which are the ones to look at in terms of your investment as well.
I see, I see.
Hmm.
Okay, wonderful. Okay, one question, and then I'll let you go. Okay, thanks for your time. Yeah,
Definitely.
so I don't want to hold you back so long. Yeah, okay. Paul is asking, is PMI forward-looking?
Yes, so I think what's been interesting, and while I'm not able to name perhaps the companies that look at our data, but across the world, not only are a lot of the major fund managers are subscribing to this data, and from which, well, I mean, I'm not saying that we should go to the extreme of being quantitative analysts over here, but definitely I think these are the people that are able to derive a lot of signals from looking at the investments, the financial market investments finance. And then on the other hand, you have corporates as well. These are the people who use this to look at their trade data to perhaps know what are the kind of demand that they might be seeing for their transportation system, for their own goods. And therefore, the data, as I said, it's one of the most looked at data around the world.
I see, I see. Okay, Paul, I hope that answers your question. And Fabian was asking where to find the data. So I think we have already addressed that question earlier.
Yeah.
All right. Okay, wonderful. Thank you so much, Jingyi, for your sharing. And I wish you Happy New Year, Happy Chinese New Year, 恭喜发财. All right. And
Yes.
I look forward to another session with you at another time.
Yeah. Thank you. And I wish everyone having a prosperous and healthy 2022. Bye.
Thank you. Okay, bye bye. And now we can move on to our second speaker for tonight, and that is none other than Mr. Ian Low from wealthlions.com. So Ian is already on the screen for a while. Sorry to keep you waiting, and please take it away.
Hi everyone, this is Ian. Thank you for joining me. I want to say, can you hear me? But I guess you can. Richard, everyone, you can hear me, right, Richard?
Yes, I can.
Okay. Yeah, 1 year has passed already. Time passes very fast. Now, some of you may be asking, what have I been doing? I picked up the new hobby, cycling, and I have a 440, I have a road bike. So whether you ride fast, you ride slow, chill me and I will cycle with you. All right. Okay. Thanks to Jingyi. Well, we have a big challenge for time. Um, I have 30 minutes with you, and forgive me if I speak very fast to cover all my 53 slides in 30 minutes. All right. So today, if you are lost and do not know how to invest with all these news about COVID, inflation, interest rate rising, I think this short talk today will give you some ideas on what direction to take. My name is Ian Low. I invest primarily
Ian,
for, yep.
Ian, sorry. Ian, you have to share your screen first.
Oops. Okay, sorry everyone. Let me see. I have, okay. Can you see my slide now?
It is loading, so should be out soon. Okay, while we wait for the screen to load, just a quick reminder to all attendees, if you have questions for our speakers, please type them into the chat box anytime. And the chat box is on the bottom right of the screen if you are using a desktop, or you will need to scroll up or down on your mobile devices to look for the chat box, and you can type in your questions for our speaker anytime. Ian, the screen is still loading. Did you need to give it permission or something like that?
Nope.
Let's wait
Yep.
for a while more. Huh?
Okay. Meanwhile, if
Okay,
you
it's out.
it's out now. Okay. If you see, you can see my website and a Telegram channel. For anyone who subscribe to my Telegram channel or to my website, you will get the slides sent to you. So you do not need to be doing screenshots. All right. You don't need to write down notes. These slides, you will receive it if you subscribe to the website or Telegram channel. Okay. And I invest primarily for passive income in corporate bonds and REITs and some ETF. All right. I'm a remisier with Maybank Securities. I'm also helping to run this club. I'm the secretary here of the club. All right. Before I start, let's go through a disclaimer. All right. It's not my intention to ask you to buy any stocks or bonds today. I'm simply sharing with you my 2022 plan, which stocks I intend to buy for myself. So did you make money in 2021? If you tell me you didn't, then look at the slide. All right. S&P went up by 27%. NASDAQ went up by 27%. Singapore 11%. Shanghai 5%. So there's only one market you could have lost money, and that is the Hong Kong market. All right. So really, 2021 was a good year for most investors. Now, let's look at 2022. What are the market trends? The first one is I want to ask you, but you cannot answer me, all right? When will pre-pandemic life resume? In a Straits Time just 2 weeks ago, a question was asked in the Straits Times, and it was asked to a poll was done. All right, how soon do you think life in Singapore will return to the way it was before the pandemic? All right, and of course, 28% here, 28% said life will never return to the way it was before the pandemic. Well, most people, 31% plus 32%, says that life will return back to normal only beyond 2023 and beyond. But there's a 9% here that says sometime in 2022, life will go back to normal. All right. Go back to normal to me is simply not having to wear a mask and we can gather in big groups again. All right. And if you are like me, and I think the worst may be over, and possibly by end of the year, COVID will be over, then maybe this is the time to invest in certain sectors. In Singapore, there are the retail malls, the land transport, taxi, buses, aviation, and maybe tourism. People who know me knows that I don't like tourism, even in the good times, and definitely in bad times, I still don't like tourism. All right, so I put a question mark. All right, I don't invest in tourism, but some of you may be interested. Another theme is, does anyone know, has QE means quantitative easing, has QE ended? Again, I suspect some of you will say yes, and some of you will say no. Maybe I'll bring you up to date, all right? A lot of words here, but let me read out to you that the Fed has started tapering since November 2021, and that is about 3 months ago, all right? Now, the story goes is that way back 2 years ago in June, after COVID started, Fed, the one in blue here, the Fed set its rate of purchases to at least 80 billion a month in treasuries and US 40 billion a month in mortgage-backed securities. So they were buying and buying every month, driving up the stock price, flooding the market with money. Okay, that was in June 2020. In November, 1.5 years later, November 2021, the Fed began tapering. It was their first tapering, means they reduced their pace of asset purchases by 10 billion in treasuries and 5 billion in mortgage-backed securities. All right, they reduced. They didn't. They still continue to buy, but they reduced. In December, they also reduced by another 20 billion a month in treasuries and 10 billion a month in mortgage-backed securities. Now, on hindsight, do you look back 2 months ago, 3 months ago, the growth stocks has been falling in all over the world, especially in the US. All right. So this account for the money being, the free money flooding market is now less. Now, today is 25th of January. 26th of January is FOMC, where the Fed is meeting and they are going to decide what they are going to do for the month of January. And the market is saying that the news will be, Jerome Powell will say, is an immediate end to QE. They will stop all purchases. That is the rumor, the speculation going on in the market, that no more, stop completely, immediate end to QE. All right. Now, what does this mean to us investors? You know, for many years, I know investors, people who believe the US market, they will always say the US market will always outperform other countries. Invest in US. And they have been right for the past 14 years. The past 14 years since 2009, after the global financial crisis, the Fed started their QE. And they flooded the market with money with 4 rounds of QE. And because of QE, the US stock market has been invincible, outperforming every other country in the returns. All right. Now I ask you, what's going to happen when the Fed pulls handbrake completely? Frankly, looking at the chart now, there is a distinct possibility that you see this is the returns of US for 10.5 years here. They have been outperforming every other market. This is US minus the returns of the rest of the world. All right. And they have been beating everyone else. Now, I think there's a possibility this year that they may not outperform the Asian market. All right. Well, there's already some clues to it. If you measure from January 2nd this year up to today, S&P is already down 8%. From January, Nasdaq is down 13%. STI is up 5%, Shanghai is down 3%, and Hong Kong is up 6%. So actually, from the start of the year, there is a clue. You know, the start of the year, the fund managers, the start of the year, they go forward, they make decisions based on what they think the year will pan out, and they are already exiting US, and Asia is going up or stable. All right. Now, another theme that I'm seeing that is that, of course, the Fed, besides withdrawing the bond purchases, they are also increasing the interest rate in 2022. They will. Will is 90%, all right? It's not 100, but very high, all right? Now, where do I get such data? Okay. This chart comes from CME. CME is Chicago Mercantile Exchange. Fed Watch tool, all right? This is in their website, which calculate the probability of future Fed fund rate based on the Fed fund futures contract prices, all right? So if you see here on my mouse, 16th of March. 16th of March, what is it saying? It is saying that there's 85% probability that the interest rate in March 16 will be 0.5%. 50 basis points is 0.5%. All right. Now, what is the interest rates now? This is the current interest rate now is 0.25%. So it's already high chance, very high chance that we will see an interest rate rise in March. Not today, not tomorrow or 2 days when Jerome Powell is not likely to say it according to all the speculators, but in March they are going to increase, all right? So of course, this is old news because everyone knew that, and that is why for the past 3 months or so, stock price, bond price have fallen in reaction to the future increase of interest rate. They're already factoring in the future increase already. Now, just the previous slide was based on March 2022, what we think or what the Fed funds contract futures is saying. Currently, now we shall look at 21st September. What do the Fed fund futures is saying that most likely what is the interest rate come September? All right, it's here. 39% is 1%. 1%, there is highest chance among the various probabilities. 40% chance that interest rate will be 1% come September. All right. So I think for us, we must know in advance, oh, there's likely an interest rate increase. What am I going to do with my money now? Okay, now this is the Fed fund rate, all right, since for the past 10 years. The current rate is 0.25%, all right? Just to let you know, it was 0.25% for many years after the global financial crisis, and in 2016, started to increase and increase and increase. And because of then it started to taper off a bit, and because of COVID, it slammed down back to 0.25%. And today we are here, and we expect by the end of the year to go back to somewhere about 1.5%. The Fed fund rate now is 0.25%, likely to be near 1.5% at the end of the year. All right. Later, I'll come back to this. This is a very important slide. I will come back to this again later. All right. Now, while US, Singapore, and Hong Kong brace itself for the interest rate increase, what does China do? 17 January, China cuts rates for the first time in almost 2 years as growth risk worsened with Omicron. All right. So China has gone the opposite. You know, everyone is saying interest rate is going to rise, going to rise, going to rise. But practically every country is worried about that. But China is doing the opposite. They are fanning the economy. They decided now to fan the economy, reducing interest rate. All right. So what does this mean for us investors? You know, there's a saying called "Don't fight the Fed." So in US, if the Fed says, "Hey, I'm going to increase interest rate," hey, don't fight it. That means stocks will struggle to increase. All right, because the Fed want to cool down the economy. In Singapore, MAS, new measures for TDSR, new measures for ABSD. So we don't purposely go and buy the properties. All right. We buy properties only when the government is telling us to buy. Now it's clearly not the time to buy. Likewise, China is telling us they are fanning the economy. So what are we going to do? What are you going to do? All right, another theme, also inflation mentioned by Jingyi just now. All right, this theme is a number one theme right now that's happening in the world. All right, and it's because US inflation is rising at the fastest rate in the past 25 years. Never has inflation risen so fast and so high in 25 years. All right. This is a very interesting clock, all right? This is like a clock, all right? Now, there are various names attached to it. Some people call it the Merrill Lynch clock. Some people call it asset allocation clock, sector rotation clock, whichever, all right? Basically, how does it work? I want to tell you how it works. You see the horizontal axis is inflation. So inflation increases here. And you see the vertical axis is growth recovers. Growth goes up here, growth goes down here. Inflation rises this way here to the right, inflation falls here. Okay, so I want to ask you now, which quadrant are we in now? You guys can't answer me, so I will tell you straight away. Inflation, right? We're talking about inflation. Inflation is rising. So inflation rises, so it must be on this side, all right? This side. And there's a clue here, overheat. The Fed is trying to prevent the economy from overheating. So they are introducing measures to reduce inflation, reduce the interest rate. So we are here in this quadrant, all right? If we are in this quadrant, Merrill Lynch, according to Merrill Lynch, is that we should invest in what? Okay, it's not mentioned here, but I know in high yield bonds. All right, in this quadrant, we should invest in high yield bonds here. Never mind. Next thing, we should invest in industrials, invest in infotech and basic materials, commodities, oil, gas, and assets that is cyclical, that goes up and down. All right, and value stocks. Value means undervalued, cheap stocks, not the companies that's growing very fast, but companies that is below the book value is below the market price. All right, you know that we have just been through a cycle of cyclical growth. So the growth stocks for the past 1 year has been climbing like crazy since the start of COVID-19. After it recovered, it just climbed like crazy. And this is the past 1 year was a recovery, and now we are in so-called overheat. The Fed is trying to prevent the overheat. All right. So I'll move on. So we are in this quadrant. So this is very important. This is what we should be focusing on when we invest this year. All right. Now, what does this translate to me? So, you know, there's a show that I watched when I was a kid, The Good, the Bad, the Ugly. Now, there's obviously a good that you should invest, a bad that you shouldn't invest. And the ugly, in the show, the ugly was half good, half bad. Sometimes it was good, sometimes it was bad. So for me, the ugly means I want to invest, but I must be very careful. It's not the right time. So if I do go in, I must be very careful. All right. So what should I be investing in? High yield bonds, commodities, energy, material, industrial, value stocks. All right. Not growth stocks, huh? Value stocks. China, Hong Kong, Singapore stocks. All right. And the ugly, now, I plan to invest in this also, but I have to be very careful. Blue chip bonds, REITs, real estate, FANG stock, semicon, US stocks. All right. I'm not going to touch government bonds. I'm not going to touch growth stocks. I'm not, especially growth stock based on future earnings. There are many companies like, for example, Google. Google is a growth stocks, but however, their earnings is not just based on the future. Even today, they are making money. So when I put here growth stocks, definitely stay out of companies that is based on future earnings. That means now this year, they are not making money. Last year, they are not making money. And we all think that they'll make money 5 years down the road. Such stocks try to avoid. That's why some of you will know why there's some companies like C Limited, that is Shopee, drop like crazy, drop by half, almost half in the past 2 months. All right. And because their earnings is based on future, Shopee is still losing money. All right. So companies that's been losing money now, but is supposed to be profitable in the future, the past 2 months dropped like crazy. And the coming year ahead, they will struggle to rise in this market environment. All right, so what to buy for me? Now I'm telling you, please, I'm telling you what to buy for myself. All right, it's not to tell you to buy at all. So for myself, I use top down to look at the sectors. What am I planning to buy? So based on this theme of resumption of pre-pandemic life, there is hotel, land transport, and aviation. And I told you about hotels, but I will stay out of hotels. And this theme of country rotation due to QE tapering in US, I think we can invest in Hong Kong. We should invest in Hong Kong and China. All right. And sector rotation due to inflation and interest rate. All right. Commodities and banks should do well this year. Now, okay, all right. I will share more with you later. But frankly, I have never been good at commodities. So, frankly, my experience in commodities is very little. So, I'm also being very careful because I don't understand much about this industry. But I want to get my feet wet because this year is the year of commodities. All right. Now, top down, 2 stocks. All right. So, CCT. CCT is not Capital Commercial Trust, or it's not that. CCT is CapitaLand China Trust. All right, they are retail malls, about 70% retail malls. All right, in China. The FCT is Fraser's Centrepoint Trust, which I will cover more later. All right. SBS Transit, you guys know, is they run buses and MRT. I try to avoid Comfort. I like Comfort Delgro a lot. I try to avoid Comfort because they are in competition with Grab. All right. And so I just worry about Grab, so I stay out of Comfort. But anyway, I'm already an investor of SBS Transit, all right? So I want to add to it. For SBS Transit, it's 30% owned by Comfort anyway. All right. Just tell you that Comfort owns 30% of SBS Transit. Now, next thing is SETS. All right. SETS, to take advantage of the aviation industry. All right. That may resume full force this year. May. All right. May. I'm hoping it does. Next, country rotation due to QE tapering. All right. Again, CCT is the same CapitaLand China Trust. All right. Now it's in China and it has dropped a lot. CapitaLand China Trust have dropped tremendously because of China's 0% COVID policy. All right. So among all the REITs, one of the worst performing REITs because it's in China. All right. The other one, okay, the rest are stock codes. JK8, YYY, HST. I'll cover it later. What are these stock codes? Because the names are very long. They are ETFs based in China. All right. Sector rotation due to inflation and interest rate. All right. So now, again, I have, okay, SPY is an ETF for S&P 500. All right. So I already have SPY, but the market is falling every day. And tonight, based on the news, it may fall further. So I'm watching out to add on to, you see, although QE is ending, although we are expected that the US will have problem, US will have challenges this year, but the theme of the year is inflation. Everything will be inflated. Will there be a crash this year? No, I don't think it'll be a crash. All right. The Fed is cooling down the economy. They are not making it to crash. They are cooling down. The moment it crashes, the Fed would keep the interest rate low and everything will be okay again. They will resume their QE. All right. So because the economy is hot, they are cooling down. Stocks will be inflated. S&P 500 may still rise, but not as fast as the previous years. But if it falls like 10-15%, I will be in. All right, I will be in. I'll be willing to enter. Now, for the commodities, Wilma, for the banks, OCBC, I think may be able to enter for those who are not entered. All right. Let me cover my favorite. By the way, for those of you who don't know my favorite, my expertise is in REITs as well as bonds. All right. So due to time pressure, I shall cover only these two topics. Commodities, another day you can ask me. All right. Now, Fraser Centrepoint Trust. This is possibly my favorite stock. I love it. It's my highest holding among all my stocks. All right. But I'll tell you upfront, there's only one thing that I don't like about FCT. All right. There's one thing bad about this. I must tell you upfront. 55% of FCT's debt is based on fixed loan, while 45% is on floating loan. What this means is that as interest rate rise this year, because of their 45% of floating loan, their earnings will be reduced. So that is why this year, although there's upward pressure that the stocks may go up due to COVID being no more, there's also a downward pressure that as interest rate rise, the earnings will be reduced. All right. Now, ideally, I want to see FCT having 70 to 80% of their borrowing on fixed. Unfortunately, it's just 55%. It's frankly lower than most other REITs. So I don't like that. But I love their properties. All right. They have 9 properties in Singapore, 9 shopping centers in Singapore. 8 of them, I love it. Only 1 of them, not so nice. Changi Point. The Changi Point is not so nice. The other 8 of them, if you visit them, you will see it's crowded on weekday, crowded on weekends. All right. It is doing very well. All right. All 8 of them are in HDB estate. Only Changi City Point is not in a HDB estate. So they are high quality suburban malls. Not a single one is at Orchard Road. And of course, Centrepoint, Orchard Road, that is not inside this Fraser Centrepoint Trust. All right. It's in the mother. Fraser's properties is the mother of FCT is holding Centrepoint, Orchard Centrepoint. All right. It's not here. All right. So now, what are these bars? These bars are dividend per unit. That means how much dividend did it give for each year. Each vertical bar is a year. All right. On the left is 2007. On the right is 2021. So you can see over here that the past years, the dividends just kept increasing. They have a superb record of practically increasing their dividends every year until COVID struck. You see here, COVID struck. And now, although COVID is still present among us, FCT is already resuming their dividends to pre-COVID level. In fact, FCT has already reported that they have reported that their footfall is very close to before pre-COVID. All right. Now, this is to show, this is a price to book. Price to book is price divided by book value. All right. Price divided by book value, yes, it's above 1. Above 1 means it's over value. All right. This is 0 above 0. Oh, sorry, above 0. All right. However, let me explain to you this. It is the lowest price to book over the past 8 years. Never have FCT been that cheap based on price to book. All right, book value is the price is low and the book value is high, so price divided book is the lowest ever. Capital China Trust. All right, the beauty of Capital China Trust is 80% of its loan is on fixed, so only 20% on floating, so it will hardly be affected by the interest rate rise. And the best thing is they are borrowing in Sing dollar, not in renminbi. Renminbi is in the government is decreasing in interest rate, but in Singapore they are likely to increase interest rate. But for FCT, 80% is borrowed in SGD, so they stand to maintain their earnings in spite of rise of interest rates. All right. Now, FCT use this chart, you'll not see anywhere. I did it myself. All right. It's not from CapitaLand. Basically, there used to be only retail malls, 67%. All right. Used to be. 2020, they added business park, 12%. 2021, they added logistic, 20%. So they have now diversified into industrial. Remember earlier, industrial will do well. All right. Office may not, but industrial will do well. And now they have industrial and they also have retail. All right. So they are now diversified. The DPU have not, you see, have not recovered to pre-COVID levels because obviously in China, the government of policy, so the footfall there is nowhere near what it was originally. But if you see the past track record, if life go back to normal in China, which we all know eventually it will, just a matter of time, there stand a chance to recover to a very stable dividend income. All right, and like FCT just now, CCT is always at its lowest ever book value for many years. And these are what I call value stocks. Value stocks are price to book at very low. All right. Now I'm going to cover 3 ETFs. All right, because I'm buying them for myself, and I like ETFs. And why everyone? Okay, these are ETFs that everyone can buy. I purposely selected 3 ETFs that what MAS will call EIPs. EIP stands for Excluded Investment Products. EIP are shares that are deemed by MAS as simple, with terms and features that are simple and commonly understood by retail investors. All right. On the other hand, SIP, meaning Specified Investment Products, are shares that may have features that might be more difficult for retail investors according to MAS. So these 3 ETFs are allowed to buy by normal retail investors. All right. Okay. So the first one is it's a handful. United SSE 50 China ETF. All right. It's run by UOB. All right. And it's in Sing dollar. It tracks the Shanghai Stock Exchange. All right. And you can use your SRS. The beautiful thing about this is you can use your SRS. Don't ask me about CPF because I don't use CPF to invest. All right. Now, another thing is the expense ratio is very, this is how much does it cost to maintain the ETF is relatively low compared to other ETFs. All right. Now, it doesn't have any dividends at all. Okay. And I provided the top 10 holdings of what this ETF does. Basically, is investing in the basket of the top 50 Shanghai stocks. All right. Okay. And the next one I shall cover is Lion OCBC Securities China Leaders ETF. Now, very similar to just now, the The other one, the SSE 50, but this is 80. Instead of 50 stocks, it's 80. And it is based on the 80 stocks that is that can be purchased from Hong Kong. All right. China stock that can be purchased from Hong Kong, the top 80 of them. All right. Likewise, you can use SRS, but this one has dividend. All right. It has dividend. And because it can be purchased from Hong Kong, you will see that if you see the top 10 stocks, it has 10 cent, it has slightly more adventurous stocks. All right. Like 10 cent. All right. The last one is Hang Seng Tech ETF. This has dropped a lot. All right, because of the crackdown in Hong Kong, and as well as the tech stocks are now not in favor. All right, but because it has dropped so much, I think we can consider, if your time frame is not just 1 year but over 5 years, I think this has strong potential. Okay, this is the 30 largest technology company listed in Hong Kong. Although listed in Hong Kong is, frankly, you see the names here, practically all of them are Chinese companies. All right, they are from China. Okay. All right. Now I shall cover when to buy. All right, when to buy. Now all of you know that I have one favorite technique to use, and it's called a stochastic weekly hook. You don't get to buy any time of the year, but you probably 2-3 times opportunities to buy in the year only. All right. For example, this is S&P 500 for the past 3 years. All right. So if you see a stochastic hook is like a little sharp end, right? So whenever it forms a sharp end and it turn back up here, I will buy. Turn back up, I will buy. So you will see that most of the time it makes money. You get to buy at the low price. Sometimes you lose money, but mostly you make money. So to me, this is one of the most robust indicators that I know. It's not perfect, but I like to use it a lot. All right. So here, you see here, S&P now is falling. When it forms a hook, a little hook, I do not know where, like a little hook, I will purchase. And let's see. All right. I'll tell you next year. All right. Now, next one, Shanghai Stock Exchange. Likewise, this is a hook you are supposed to buy here, a hook you're supposed to buy here, a hook you're supposed to buy here, a hook you're supposed to buy here. And likewise, a hook is falling, is forming. A hook is forming. So I'm waiting to buy, all right, SSE. So when I see SSE doing a hook, I will go and buy just now the first 2 ETS from China, the SSE 50 or the China leaders, all right. Okay, all right, so ignore this already. This is my mistake, this red circle here. But this for STI, Straits Times Index, and these are the little points where you are supposed to buy. So even when you buy here, it will rise up, but if you keep holding, it will fall down. So you buy here, it will go up, buy here, it goes up. So you generally, stochastics indicator allows you to buy for that period low price, but we never know 3 months down the road, 1 year down the road, whether it goes up and down. It is not predictive for the forever, but all it does is give me some assurance that for that period when I'm buying, it is a low price. All right. FCT, likewise, this is past 2 years. Opportunities to buy here, 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 and it just happened only, which I bought also. All right, okay. So you don't need to buy a lot. Just buy a small amount. You don't put 100K. You put maybe 10,000, a small amount. Each time when it happens, your favorite stock, you just buy a small amount. All right. Sets also likewise. Sets. This stochastic hook is here, you buy here. A hook is here, you buy here. A hook is here, you buy here. Hook is here, you buy here. And the hook is here, you buy here. All right, it just happened only. All right. Now, corporate bonds. Okay, this is a Fed fund rate, and most people, if you read any analyst, practically anyone, they will say, don't get into bonds. All right. Yes and no that they are right. All right. Most of the time when they say don't get to the bonds, they are meaning government bonds, they also mean unit trust bonds. All right, because these people who said don't really understand corporate bonds, and I will explain to you why. But before that, if you see here, the Fed fund rate increased in 2016 to 2019. Let me tell you, I continued to invest in bonds. During that period, a lot of my clients, not a lot, maybe half of them, I were worried they stopped buying bonds. I continued to, and today I can tell you, these bonds that I bought were the best bonds that I bought. All right. The reason is when they stop increasing interest rate and fall down, the bonds that I bought at very good prices. The price just all shoot up. All right. I bought during the time of rising interest rates. People were all scared to buy. When the interest rate started to fall, my bond prices escalated in price. All right. Okay. Now, that's one of the reasons. Now, other reasons is you must understand what affect the price of corporate bonds. Not government bonds, not unit trust bonds, corporate bonds. All right. You must understand that. For a triple A bond, because it's so safe and so super safe, all right, the credit quality only have 30% impact. 70% of the impact are the interest rates. So let me tell you, Maple Tree bonds, the past 2 months dropped a lot because we all think interest rate will fall. Interest rate will rise, and we believe bond prices will drop. So many people who hold Maple Tree bonds, they sold, and the price dropped. Is because when the credit quality is so good, interest rate has a big part that determines the price of a bond. In the opposite side, when you buy a hopeless bond, junk bond, interest rate hardly ever affects. So let me tell you that when the interest rate rise, if that bond is a stock, a bond like MM2, some bond that no one wants, all right, interest rates hardly affect the movement of that junk bond because people who buy junk bond only look at the credit quality. They completely ignore the interest rate. So for myself, I prefer such bonds. I want an average quality corporate bond that has some interest rate impact, but still, when I invest, I am taking on credit risk, not interest rate risk. So interest rates rise down, I don't care. I give it to you. But I'm going to make the money from the credit risk. All right. So reasons I like corporate bonds is that the coupons I earn even during times of interest rate increase, I like my returns. So even though it's less, I don't mind. It's all right. All right. Most analysts, when they refer to bonds, they usually prefer they are referring to government or unit trust bonds. When I buy corporate bonds, I'm taking on mainly credit risk rather than interest rate risk. I'm contented with less returns, and all I want is to sleep well at night with some and sure returns from the market. All right. Now let me share with you my investment portfolio. All right. This is what I have now at the start of this year, coming this year. So 45% of what I have is in stocks, 2.2% in government bonds. Very little. You know why? Because it will be impacted by the interest rate. So I keep very, very little. And majority I have is in corporate bonds, 53%. All right. Let me tell you that 2021 last year, this portfolio returned me 50K. All right. So not a lot. Some of you it's peanuts, but to me, it's just nice just for my corporate bond. This is just for my corporate bond. I did not bother to calculate how much my dividend for my stocks returned me, but my corporate bonds returned me about 50 plus K. So I round off to 50K. This year, I'm expecting it to return me 66,000. All right. So 66,000 just sitting down. All right, interest rate increase, never mind. I will still collect my 66,000. All right, for my shares, my top 8 holdings. Number 1 is Fraser Centrepoint Trust, followed by UOB, DBS, CapitaLand Integrated Commercial Trust, this is a government bond, all right. This is my only government bond that I have, all right. This is a Hong Kong REIT, Link REIT, Keppel DC REIT, and Ascenders REIT. So this is my portfolio, my top 8 here. All right, so overall, this is my last 3 slides. All right, so my overall plan for 2022 is I would like to ride the inflation trend and the reopening plan. I prefer Singapore, Hong Kong, and China stocks to US stocks. I prefer higher yield bonds, not the junk bonds, but take some risk. Something like uh, AIMS, REIT perps, or something like Olam perps, all right, or Olam bonds, something along that lines, all right. Focusing on value, I will focus on value stocks instead of growth stocks. And I want to stay invested. All right, I want to stay invested. And when any news that come, it doesn't mean I will sell. All right. In fact, any times the market comes down, I will use my stochastic hook to try to buy. In the long run, I believe the market rewards me who stay invested and not to react to any news. All right, this is my last slide. I would like you to join my mailing list at wealthlions.com and Telegram channel at this link. All right. If you like what you hear today, please join my. You can receive the slides for today's presentation simply by subscribing. All right, and be notified on my free training on bonds. Be updated on my REITs with rising DPU. All right. And for those of you who are new to me, if you need any help with your bonds and REIT portfolio, please contact me. Go to this website, wealthlions.com/contact, and you drop down your mobile phone and contact me there. All right. Thank you very much for your time tonight. Richard.
Yes, thank you, Ian. Wow. That was fast.
That was fast. Wow. What I think is how long did I take?
Huh? I don't know, but you zip through all your slides.
Okay, yeah.
Yeah, but
Okay.
not to worry. To all the attendees, the webinar is being recorded, and then you'll be able to watch it. And then, if you miss out on any of the stock tips that Ian have been dropping all over his slides, you can watch it again. All right, and then if you join his Telegram channel by searching for Wealth Lions in Telegram, you can join that channel, and then in the next couple of days, he will send the slides to you. So join it if you want to receive the slides, okay? So, and also if you need help with your investment, like specifically for bonds and REITs, which is Ian's favorite, so you can reach out to him at his website, wealthlions.com/contact. So without further ado, now in view of time, let me get straight into the Q&A. Let me see. Okay. Okay. NK is asking whether the stochastic hook, what is the settings? Is it fast stochastics or slow stochastics?
Yeah, okay. MK, actually it's a bit of aggravation, but I'm using 933. All right. Fast stochastic 933, but and weekly. It's weekly and not daily. Yeah. Weekly fast stochastic 933. But really, if you use slow, if you use 1433, it's fine also. All right. So really, you have to just experiment and find one that suits you. And in the end, is charting is a bit of aggravation. All right. Okay. Yeah.
Right. Okay, cool. And also, Ian, on your website, under the education menu item, you also elaborated on how this stochastic hook works.
Wow.
So for
Thank you,
those
Richard.
attendees who wants to
Yes.
read up on what Ian blogged about how the stochastic hook works and how he use it for his investments, please go to wealthlions.com and click on the education link, and you will find the articles that Ian has written on how to use stochastic hook. Okay, NK also asked, what about data center REITs? It has dropped so much, should he like look at it?
That's a very good question. All right. Now, specifically, I think you are mentioning the person is asking about Keppel DC REIT, Keppel Data Center REIT. All right. It has dropped so much, it's continuing to drop. All right. And I'm still watching it, and I'm holding. It's one of my top 8 now. All right, it's one of my top 8, and there's nothing wrong with the company. Um, I am still waiting to go in. All right, this is a clue. It is not about data center being bad. All right, but it is that capital DC has gone up so much already. So it is now adjusting in to its real fair value. All right. Just to let you know, okay, Rao, I do not know what's the name of this new REIT. It's something like
Digital core.
DGCOM,
Digital core.
Digital Core US
US dollar.
REIT or something like that. All right. Yes, there's it just IPO like less than 3 months ago. All right. It is rising in the midst. The past 3 months, it has been rising. All right. So data center is not that the data center is bad, but when something is undervalued, like this digital core, it is rising. And people and investors are comparing the dividends they get with digital core, comparing the dividends they get with capital DC. So capital DC came out to a point where the dividend is just 3%. So now it's adjusting to 4 plus, catching up. All right. So let's wait. I will let you know when I enter again. All right. Okay. Another interesting thing is Maple Tree Industrial Trust. It also has data center, but I think we have not much time. That is another story that we can talk about one day that we can consider to look at for data center. All right.
Right. Thank you, Ian. Okay, let me see. The one question I think from Catherine, she's asking where to buy CCT and SSE.
Oh, okay. Those three ETFs I mentioned just now, you can buy it through me, Maybank Kim Eng, online. All right. So it is a Singapore stock counter listed in Singapore Stock Exchange. There's no custody fees. There's no special thing. It's like buying DBS, buying any Singapore stock. All right. You just need an account with any local broker, and you can buy these three ETFs.
Right. Okay, wonderful. And this is the last question for you. And it's from Zion. Zion is asking, thanks for sharing when to enter and noted that you would like to stay invested. My question is really when to exit.
Wow, that's $1 million question.
Yeah, that's why it's the last question.
All right. Okay. Frankly, my original plan. I just tell you about myself. I intend never to exit. All right. And I tell you that each time I exited, I regretted. Seriously, all right. So, um, when during COVID times when it crashed, I exited some. Of course, I should have held because everything that I exited went up in price. All right. So, so likewise, I would say the market generally is very forgiving lately because of the quantitative easing. All right. So generally, and it has been tested over many years, 100 years in S&P, for example, that if you hold S&P 100 years ago and now you'll be a millionaire by now. All right. So over the long run, there is no need to exit. But if you are trading an economic cycle, just one economic cycle. Right now, we are at the inflation phase where things are getting inflated. Now, I didn't cover the investment clock in detail just now. The next quadrant is the quadrant where you are supposed to go into cash. All right. When growth is no more. Now, economy is still growing. Government is trying to cool now. But when growth is no more, when there's no more growth, you're supposed to go into cash. All right. And await the next cycle to buy again. This is based on fundamentals. All right. Unfortunately, I do not have a technical indicator that tells me when to sell everything. All right. Zion, I'm sorry. Yep. Okay.
Okay, can. Okay, Zion, sorry, not able to answer that technically, but I hope that answers your question as well. All right. Thanks, Ian. Thank you so much for your sharing. And I'm sure that for those of you who have joined the Telegram channel, will be able to be informed of additional insights from Ian in the days to come. So don't forget to join his Telegram channel. So thanks a lot, Ian. Thank you for your time.
Pleasure is mine.
Okay. Right. Now, time check. It is 9:13 and we are at the last speaker for tonight. And there's none other than Mr. Kenny Low, who is a REITs expert and also a MAS licensed fund advisor. So let me now hand over the mic to him to share his insights on the Singapore REITs market outlook for 2022. And because of time, I would just like to say that we probably will be going over time. Let's give Kenny about half an hour to 45 minutes to cover his slides. So if you have any further questions from there, you can also ask tonight. Stay back, and then he will be happy to answer them. Or you can also reach out to him personally to seek his opinions and advice after the webinar. So Kenny, over to you, please.
Okay, Richard, can you see my screen and hear me?
Yes, I can see your screen and hear you. And for all attendees, if you have questions along the way, please type into the chat box so that I can ask Kenny at the end of his sharing. Okay, Kenny, back to you.
Yeah, okay. Tonight, I only got one topic because I know that Jingyi and also Ian, they cover a wide range of topic. So it's pretty intensive. So tonight, I only talk about REITs and REITs and REITs. All right. So, okay. My slide's not moving. Okay, basically, a quick introduction of myself. If some of you do not know who am I, basically, I'm a certified financial planner from an independent financial advisory firm. At the same time, I'm also the SGX trainer and also the IBF trainer. I have a SGX REIT course coming up in March. At the present moment, it's not open for registration yet. If you are interested, you can join my Telegram later or just now. Richard has shown to know when is the next class. I'm also giving a monthly market update through Money FM 89.3. If you Google me, basically, you can hear all my REIT market update on the Money FM. Okay, my stock investing is my blog. You can go there to read my monthly update and also compilation on all the REIT information. At the same time, I'm also conducting one-on-one face-to-face interview exclusively with some of the REIT manager, so that you know much more insight from their interview instead of you just reading all the information from the internet or from their earning release. Okay, today trade agenda. I'll go through a quick review on 2021. How's the Singapore REIT market is doing? And also, how will the interest rate hike affect the S rate? I think many people, I received many questions and also concern about the interest rate in this year. And lastly, how are we going to invest in S rate in 2022? Is it a good time to invest? Or if you want to invest, what is the best strategy to invest? Okay, let's look at the market recap. Okay, basically, the whole 2021 REIT sector is a laggard performance if you compare to the STI and also compare to the financial sector, right? Is it a bad news for REIT moving forward? Not necessarily, because everything moves in cycle. If the financial sector has already moved up a lot in 2021, probably the upside a little bit limited when we move into 2022. And maybe it's a time for the REIT to cash out due to the lower valuation. But if you compare to the REIT performance of Singapore and also US, US REIT has already on the uptrend for many months and also close to the historical high. That's why during this period, the correction is more severe. But if you look at Singapore REIT itself, basically they are still trading on a sideways movement. Right? Although S&P 500, NASDAQ, that dropped a lot, close to a double digit, but you look at the REIT itself, basically they are not really dropped a lot. It's still pretty resilient during this period. Okay, and REIT index has been range bound for the past 18 months, basically moving nowhere. We are now in 2022, upon the recovery, we are just waiting for the breakout. And unless there is another Omicron, we don't know what kind of name coming out, variant coming out, unlikely there will this REIT index itself, they'll break down and form a new low. And COVID variant little sell-off basically happened in 1 month ago. You can see that when the Omicron start to invade Singapore, invade and this part of the world, they are still a little bit sell-off. They never crush a crash. All right. At the present moment, Omicron basically no impact, right? Maybe people are also talking about Omicron may end this pandemic. So far so good for the time being. Singapore REIT are still holding pretty well. And if you look at the top 5 best performer in 2021, okay, surprisingly, they are not all the blue chip, big cap, MACF REIT. Okay, Mapletree, Ascenders, CapitaLand, and also Fraser. All right, 2021 basically is a small and mid cap REIT. They are playing cash out. That's why you can see that Alloc can go up by close to 50%. Star Hill Global, Sabana, First REIT, all those names, some of the names you hate it very much, all right, based on all the past experience, but past bad experience, like Sabana REIT and also First REIT, they have actually one of the best 5 performers in 2021, all right, and while the REIT index, they just moving sideways. And there were 4 heavily king best performer in 2020, which are the Ascenders REIT, Mapletree Logistic Trust, Mapletree Industrial REIT, Cable DC REIT. Basically, they performed pretty badly this year. Right? Later, I will give you some my analysis. Why were they perform pretty bad this year? That's my analysis and based on my observation. Right? So the interest rate hike. Interest rate is predicted to go up. Jingyi and also Yan talk a lot. Okay, basically, I just want to give you one snapshot. Right, in 2020 itself, based on the dot plots, there are 75 basis point. That means that the highest interest rate probably will be hitting 1% from the current 0.25%, and in 2023 probably you'll be around 2% area. And in 2024, basically you pick at the 2.5% area, and longer term you'll be at about 2.5%, right? Interest rate. You just need to bear in mind of this interest rate number, because later I will show you some correlation with the REIT chart. Okay, if you compare to the past history on the interest rate, 0.25%, 1% is really just starting it is still pretty low compared to the history. Okay, so it's nothing to seriously worry about. And this chart is similar to what Yan has presented. 0.25% probably will happen in March. All right, the probability is quite high. For me, more or less, is a done deal. We are going to have at least 1 rate hike in March based on this probability map. Okay, but if you look at June 15, the probability is less than 50%. Okay, by increasing any 25 basis point. Okay, it's not confirmed. The probability is still there, but it's not really confirmed yet. If you look longer term, September 2022, the probability is only 38%. Okay, so the other 2 rate hike is not so sure it's going to happen yet. It very much depends on the economic condition moving forward. So I would say that at the present moment, 1% target would be probably the maximum interest rate probably in this year. So I know quite a number of investors from my forum, from my client. They always really worry about the interest rate hike will cause another market crash. Okay, so I will show you some data. Okay, basically, don't panic. The sky is not falling. The sky is not falling. Okay, do not panic. Okay, first thing, I just want to calm everyone down first. Okay, back to basic. Why the interest rate increased at the first place? We need to really understand the event. Right, the interest rate increased because the Federal Reserve they are using an interest rate tool to really tame the inflation. Okay, Jingyi has talked about the supply chain risk, the demand and supply. Okay, basically in short, in the layman term, economy is doing very, very well. All right, and the Federal Reserve have to cool it down before the inflation out of control. So you can see all the headline news. Unemployment is falling fast. And 2022, 2021, the economy is booming. That's why they use the booming word, right? And also from CNBC, basically the job market is tightening. More and more people, they are able to get employment. The wages is going up. and the economy is healing, and leading indicators also suggest economy you keep growing, and global economic growth you grow by estimated about 4% in 2022. That's why you are seeing that all the economy is doing well, is recovering, and the demand is more than supply at the present moment, cause all the commodity price going out, and factories adding the capex to expand the capacity. All these things eventually will give a good, better revenue growth and also profit growth for those business. If the business are recovering well, eventually their earning per share will be performing well, and that will lead to the boost in the share price over the long term. Okay, so relax. Economy is doing well. This is not end of the world. Do not really so scared about the interest rate hike, right? So the next few key thing I will share how the interest rate hike affects REITs in 4 ways. There are 4 impacts to the REITs. Some of them positive, some of them are negative. So we will look at the rental income, how interest rate hike will impact the rental income. And the next one, I will talk about the interest cost, because that the borrowing cost is important, because that will impact the DPU, distribution per unit, and also how will affect the yield spread. And last, I will show you the correlation of the interest rate hike overlay with the S-REIT index. Okay, first thing first, back to basic. Let's look at the business model, how REIT generate the income and how REIT distribute the dividend back to the investor. Right, basically there are 2 forms of the REIT raising fund. One of the way is borrowing from a bank, borrow from a creditor, and also the other fundraising is to issue additional share, IPO, raise a fund from an investor. Once they get the money from a creditor, banks, and also the investor, they can go and buy the property. And from property itself, the property will generate the rental income. And after paying off all the interest expense and all other working capital, the remaining 90% taxable income has to pay back to investor as a dividend payout. All right. Now, let's back to the basic. Under the inflationary environment, okay, if you are a business owner, your raw material you are buying from a supplier, they increase the price. Right, and at the same time, your landlord you start to chase you to increase the rental or drop a rental. Right, they will increase your rental. Okay, and when the business in the expansion mode, demand more than supply. Basically, you need more office space, and that will really eventually increase all the rental across the different sectors. So under inflationary environment and also business expansion mode, the property rental income will be much better. Okay, I can show you some of the data. Right, at the present moment, we are not talking about the end of the world. If you look at all the REIT itself, occupancy rate remain very high. Okay, if you just look at you just scan across most of the REIT in Singapore. Okay, you can go to the screener to do a scanning. Right. Occupancy is pretty high. At the same time, weighted average lease expiry is also very high. So in the short term, there will not have any impact in terms of the dividend collection. Right? That will give a stability and also sustainability of your dividend income. At the same time, you also can see that grade A office rent start to increase for the past 2 quarters. Okay, this slide I got it from CICT, Capital Land Integrated Commercial Trust. You can see that for the past 2 quarters, the rental start to reverse. In first quarter, second quarter, we were hit by the COVID, hit by the lockdown. Of course, you have a negative rental reversion, quarter and quarter change, you have a negative value. And now at the present moment, we already bottoms out, coming out and start reversing. So based on this trajectory, okay, it's expected the rental income for a grade A office at a CBD area, you continue to goes up. Okay, that will help to boost all those office rental, and at the same time, the commercial office rate will be benefited from the increasing dividend. Industrial rental index is also going up. You can see clearly from here, he has been stagnant for quite some some time. And you can see that the based on the latest earnings, so-called latest data from JDC is started to turning up, and also multiple user factory also started to turn up. Okay, the demand is back in the industrial, and they are not really impacted too much, and also all the rental actually is going up. Retail sector has recovered. I got this one from the Fraser Center Point just now. Ian mentioned a little bit about it. Although the mall is not 100% open to the public yet, they still have a crowd control. That's why you can see that this gray line is the pre-COVID traffic, okay, in terms of average. At the present moment, 2021, FCT, the traffic is around 56% only. It's still not fully recovered, but if you look at the tenant sales trend, it already has recovered back to the COVID. Basically, the dividend payout itself and also the rental collector do not have any impact, which means, in other words, the dividend DPO has recovered, but the share price has not catch up yet. What does it mean? That means that there is still a very high potential probability increase in the share price. Okay, second point, let's look at the interest cost. Okay, because if interest rate goes up, those REIT have to pay higher interest expense, and at the same time, you affect the DPO. Okay, now those REIT with high gearing ratio and with short weighted average debt maturity will be adversely impacted. The reason being is because they need to do the refinancing in a very short term. When they refinance under the rising interest rate environment, they have to raise the fund at the highest interest rate. That will have an impact on the DPO. Okay, so investors should need to pay attention to those REIT with have very high gearing ratio. You can see that the list over here, high gearing ratio. At the same time, the debt maturity profile is pretty short. For example, EC World in this case only 0.88 years, but EC World basically they are in China. They may be the borrowing in China renminbi. It may not be affected. So not necessarily when US interest rate high, you affect all the risks, because it depends on which country and what kind of currency they are borrowing. Okay, and if you look at the interest cost itself, at the present moment, the all-in cost is a 2.91, and also you have to look at the fixed interest rate as well. Okay, in short, not all the rate will be impacted by the interest rate hike. It's very much depends on their debt profile. Okay, in this example, this rate will have the bigger impact, because 28.4% of the debt they have to refinance this year. When they refinance, definitely they will have to refinance at the higher rate, okay, if they borrow in USD or even the Sing dollar, but not necessarily in renminbi, right? And next year, they will also have a big impact. So this rate, most likely, they will have a higher impact on the interest rate hike. But if you compare to another rate, basically for the next 4 years, 2022, 2023, 2024, 2025, they do not have any debt to do the refinancing. So whatever happen in the interest rate, whether go up by 10%, 20%, basically the DPO for this rate will not be impacted. So investors have to look at individual rate, look at the debt profile, because not all the rate will be impacted. Okay, and this is a bubble chart to plot the gearing ratio and also interest coverage ratio over here. Okay, interest coverage ratio measure the ability for the REIT itself to pay off all the interest expense. The higher the number means that they can pay off the debt easily. Okay, for example, in this case, Keppel DC have very high ICR. Okay, and compared to the rest. So Keppel DC, if the interest rate goes up, basically the interest expense will not lower their ICR. But for those REIT which has very high gearing and also very low ICR, okay, that would be the concern, because if they are not able to serve all their interest expense, and they may not be, beside they are not able to pay the dividend, or the dividend has to reduce, they may have an issue, they may face bankruptcy, because if they are not able to service their loan. Okay, but it also depends on how much secure borrowing they are borrowing from a creditor. Okay, the third one is a yield spread. Right, basically Singapore and US government bond yield, the 10-year government bond yields, they are highly correlated. You can see from this chart over here. Okay, at this present moment, Singapore 10-year bond yield about 1.8%, US 10-year about 1.7%. So in short, when US interest rate goes up, Singapore interest rate will also goes up. All right. So for those borrowing in USD or SGD, you'll be impacted. Okay, and what the how the compression of yield spread will affect the share price. Okay, I'll go slow with this chart. Okay, on this blue line represent the average yield, distribution yield for the REIT index. All right, at the present moment, the REIT index giving a yield about 5.5%, and this yellow line is a Singapore 10-year benchmark government bond yield. On this green line represent the yield spread. Okay, the definition of yield spread is the difference from of the S-REIT dividend yield minus the 10-year government bond yield. So when interest rate goes up, this yellow line yield goes up. So if the dividend yield moves sideways, basically there's a yield spread compression. All right, at the present moment, the yield spread about 400 basis points. If the yield spread is tightened, the portfolio manager, all right, around the world, they will do some portfolio rebalancing, because this is they're already built in a formula, right? They will allocate some of their portfolio, selling off some of the REIT, and then move into the government bond yield or treasury bill for risk management purpose. Okay, that is the reason. Whenever there is an interest rate movement, there are a lot of rebalancing work from all the big institutions and big portfolio manager. They are rebalance the portfolio. That will create the so-called the market and also price volatility. And the big cap REIT will have the bigger impact because they have a higher weightage percentage in the all those index. Okay, for example, the REIT index, the FTSE REIT index, or the global NAREIT index. Okay, so this is what is happening now. So this is to answer some of the investor question. Why are those big cap REIT, MIT, MLT, Ascenders, Capital DC, why they are dropping drastically? Because there are a lot of rebalancing is going on now. Okay, but at the end of the day, the fundamental of the REIT and also the macro view on the REIT and also the economic growth, economic recovery, this thing does not change. Okay, and this rebalancing will also cause a lot of panic to the retail investor. You should know that for the past 2 years, because everybody locked down at home, there are a lot of newbie investors, right, coming into the market through Robinhood, okay, and through all the low-cost broker. They have not experienced all this kind of market volatility before. They do not know how the market crash happened. They have not experienced the market crash. They have not experienced the 5, 10% or 20% that kind of market correction. That's why as and when there are some really ripple or changes in share price in the market, they're panic selling, right? Why I know that? Because I receive many this kind of similar question almost every day. Number 4. Okay, this few chart will be important, right? This is the chart of the previous rate hike from 2016 to 2018. Some of you probably have seen this chart before because I presented at the SGX forum last time, also talking about the previous rate hike, how's the previous rate hike affect the S-REIT index, okay? And you can see from here, okay, this point, the blue arrow is pointing at the exact date of the rate hike. So the exact date of the rate hike will be sometime when we go back to last time, December 2016. All right. So when the rate hike to 0.75%, okay, the REIT index have some knee-jerk reaction. Then after that, continue goes up. So at the phase one, when the rate hike goes from 0.5% to 1.5%, okay, which is about 1%, right, increase in interest rate, the REIT index itself basically is going up and up and up. Right, so do not need to worry because okay, but anyway, this is a past performance. It does not mean that moving forward, they probably will follow exactly this kind of path. All right, so before the actual interest rate goes up, you can see from here the REIT index actually also anticipate the REIT index. There are some panic selling over here. Okay, this is exactly what happened now. Before the actual rate hike, there are some correction in the market. Then after the announcement itself, everybody confirm it. Okay, you increase to this level. The confidence come back and push this thing up. Okay. Then after that, they are just going through some slight so-called market correction, but it is not really a crash. Okay. And for 2 years itself, right, from the interest rate go from 0.5% to 2.5%. Okay, 2.5% end here. Okay, total REIT index actually go up by 30%. This one is purely on the capital gain, purely on the price. 30% increase in the stock price of and this 2 years itself, the annualized dividend is about 6%, so 12%. So if you find the opportunity to pick up some of the good and also fundamentally strong rate at a huge discount and just hold through and ride it through this interest rate hike cycle, okay, based on the past experience, you already have a 42% total return in 2 years. Okay, will the rate hike to doom the equity, you cause the whole S&P 500, the US market to crash? Okay, this chart I borrow from IFAS and also Bloomberg Finance. Okay, you can see from here, these were the 2 cycle of the rate hike from 2004 to 2006 and also 2016 to 2018. When the interest rate goes up, the stock market continue goes up and rally. Okay, basically it's back. It just go back to fundamental. When interest rate high, that means that economy is doing well. They need to cool the inflation. Economy doing well, business will be doing well. Eventually, the stock price you'll be catching up because the earning per share, they are all increasing, right? As simple as that. And Asian REIT has shown a resiliency in the rising treasury yield environment. You can see from here, this chart show you from 2008 to 2021. On the blue line is the line for Asia REITs, all right? Basically, they are just doing their own thing. Because eventually, everybody must understand when you are invest in REIT, you are investing in property, right? When you're investing in property for passive income, what is the most important thing you are paying attention to? Investor invest in the property for passive income. The most important thing, you are just waiting for your tenant to pay the renter. And every month, as long as the renter coming in, they are able to cover all your expense. They can pay on time, and also the amount you requested. Basically, you don't really care about how the property price is moving. Whether moving up, moving down is basically none of the investor business. Thus, the price will only relevant when the investor, they want to sell away their property. So this is a very, very important thing to take note. When you're investing, your main focus should be on a dividend, sustainability of dividend and regular payout for the dividend. The share price movement is just part and a parcel of this stock market as long as tradable. We call it market noise. Okay, and I quote a few examples on the DPO impact during this period, last hike period from 2016 to 2018. You can see that as long as you choose the well-managed REIT and hold through the whole period, you are basically have an increase in dividend. In rate hike, basically have no impact on your dividend payout. This is one REIT. You can see it, there's another REIT. also do not have any impact. So what would be the investing strategy in 2022? First thing first, I would always recommend my client or my investor or my student, you have to focus on a personal objective. If you focus on the wrong objective, you'll be choosing on the wrong tools and also make the wrong decision, right? You have to ask yourself, are you investing for long term? Are you going after capital gain or are you going after the stable dividend, right? Define that objective clearly first, and after that, choose your asset class. Once you define this clearly, I guarantee you can make the decision better and you can sleep well better. And REIT tends to be a good hedge against inflation. Under the inflationary environment, okay, you know that probably most of you have already read the newspaper for past 1 or 2 days. If you do not know, I'll ask you the question, what is the headline interest inflation in Singapore now? Okay, you can type it there. Okay, if you do not know, I'll give you an answer, 4%. 4%. If you park your money under the cash, under the bank account, you're going to lose your purchasing power 4%. If this inflation continue to be sustained for the next few years, you can see your money shrink even faster. So you definitely need an asset class at least to really beat inflation, right? So for Asia REIT itself, you can see that based on the dividend payout, okay, Asia REIT, the average dividend return, they are ranging between 4 to 6%, right? That definitely you beat all the inflation to most of the country. So REIT, based on the data itself, REIT is a good asset class to really hedge over the inflation, to really at least to protect your purchasing power. So okay, this is the full recovery play for the REIT investing strategy. Okay, under the current macro environment, okay, although the interest rate goes up, but we are still under the ultra low interest rate environment. I have already shown you the chart. You go up to 1% is still considered very low, right? Although they will be increasing in short term. QE still in play, but reducing, but not totally cut down, right? And during this year, it is expected because of the liquidity in the market itself, there are still a lot of acquisition M&A going on in the REIT space, right? Because over the long term, the portfolio size of the REIT will definitely grow because every REIT, they have to grow their DPO. The only way to grow the DPO fast is through acquisition, right? And they also want to increase their market capitalization so that they can get more investors and their REIT can really grow faster and also have a lot more trading volume, okay? And because moving long term, we will definitely have an inflation. Property is a very good asset class against inflation. And because of population growth, there will be the demand, strong demand on the property moving forward. But of course, you have to choose the right property. You don't choose the wrong one, all right? So if you want to invest, this is a good time to start to pick up REIT now. Okay, the last best time, okay, the best time was during the market crash because this was the time you can pick up the REIT which is super undervalued, but there's an uncertainty in terms of dividend, right? Now at this point of time, although the market already recovered, you are no longer can get a huge discount on those REIT, but at least there are some of the REIT that still give you some of the very attractive valuation. At the same time, the visibility of a dividend is much clearer now. So it's much more safer to invest the REIT at this juncture. Okay, so there are good opportunity for you to get some discounted REIT, and more importantly, you have to focus on the long-term yield and the growth. Okay, why long-term? Okay, it can be 1 year, 2 years, up to 5 years. Long-term wise, the share price will definitely goes up during this recovery play. 2 reasons. First reason, dividend definitely will come back. Definitely, because last 2 years were the very poor year. There were a lot of REIT to cut dividend. This year, you can see that reopening, back to office, the business start to come back. The dividend will definitely return. When the dividend definitely will return, definitely they'll give a boost to the share price because investor want dividend. Okay, that's the first reason. Second reason, the valuation of the property will increase because all the valuer, they have to make very conservative valuation during this COVID period because they do not have any visibility. They have a lot of uncertainty. So in terms of valuation, they put in a lot of assumption. That's why the valuation were beaten down. But now with everything has much more clearer, they will be start to adjust or remove some of the constraint or assumption and improve some assumption, and that will boost in the NAV value, net asset value. When the NAV value goes up, your share price will go up because there is always a ratio. So at a juncture, a good time to really do some shopping, right? Because there are some discount, and once you lock in the discount, what you need to do, you just need to wait and forget about the market volatility, all right? Because you continue to volatile for the whole year itself. Over the long term, just aim for the yield and also the NAV growth. Okay, but importantly, you have to choose the right one. If you choose the wrong one, you are doomed. Right? This is the another bubble chart to show the distribution yield versus a price PNAV. So on the left hand side itself, basically these are the REIT which is undervalued. You can see quite a number of them, they are still undervalued. Right? Some of them already overvalued. That's why you can see that MLT, MIT, KDC, those are the overvalued rate. That's why it's not surprisingly during this correction period, basically they have to really move back to the lower range because they are really overvalued. Okay, just now there were a question asked about Keppel data center and also the digital core. You just compare the price to book. Price to book at the present moment for KDC about 1.9 times. And also digital core about 1.4 times. The yield is not so much different, right? It really makes sense that you can just rotate some of your investment from KDC to the DG. Okay, so you can use this bubble chart to really help you to do some screening and do much more detail later. Okay, and many REITs are very attractive based on valuation. All right, I have a so-called plot here, PNAV, 1 year high and low, 5 year high and low. You can see that these are the REIT. They are blue chip. They are really blue chip REIT. Ascenders, Keppel data center, Fraser, Logistics and Commercial, MIT, MLT, MCT, they are trading at a PNAV of 1 year low. And PNAV, they are not even on the higher range yet. So based on valuation itself, is pretty attractive. And there were also divergence in PNAV versus the NAV. Okay, these were the 4 REIT. Okay, some example, you can see that the NAV value keep on increasing. Okay, NAV represent your valuation of property. You just imagine your property you own is increasing value year over year. That is an intrinsic value. But somehow the share price is coming down. Share price is coming down. Share price is coming down. Isn't it? It's a very good opportunity for you to really enter, right? We are just based on fact. We don't use the emotion to really invest in the REIT space. So purely based on the valuation when you do your REIT investing. Okay, and FTSE REIT index today actually retraced back to the support level. This support level has been tested quite reliably for the past 5 times. Okay, will tomorrow break down? I do not know. Okay, but based on the valuation, based on the technical analysis, it looks like at the present level, it looks like good entry level. But of course, you have to do your due diligence, and also I'm not the fortune teller. I cannot predict a market. I only can base on the analysis to advise my client and also do my own reinvesting. Okay, so it's important to pick the right REITs. Pick those REITs have the good track record increasing in the dividend. Okay, don't pick the wrong thing. You pick the REIT itself, although very undervalued, but the dividend yield is keep on dropping. Okay, those are the wrong REIT, and you most likely you end up you lose money. Okay, it's important to look at those REIT which have grown in the DPO over the long term, because if you are able to capture the price at a discount, as a huge discount, actually over the long term with increasing of dividend, your yield on cost will be much higher than what you are getting. Okay, for example, in this case, right, at the present moment, the market yield give you about 5%. But if you bought this REIT 10 years ago, right? You bought at 110 with all over the years, you have an increasing dividend. Basically, your yield on cost is 12%. Is very, very attractive. Okay, so selection of your REIT can make or break your investment. So it's very, very important. You need to understand the fundamental analysis and also understand all the financial ratio on the REIT. There are many, many ratio here. So most of the REIT, they are not the same. Okay, I show you some of the example. We have a healthcare REIT over here. They have a very strong fundamental, but overvalued. For this industrial REIT, basically they also have a very strong fundamental, high yield, and also trading at a fair value. So there are some opportunity in the market now, and this REIT is a mix and also diversified because they comprise of the retail mall and also commercial office. Fundamental are strong and also have very attractive valuation and also good growth potential. But they only have 4 property, right? The anything happen to the property, you have a big impact on the DPU itself. Okay, and we have a hospitality sector REIT. Everything looks very cheap, okay, in terms of valuation, because you just imagine the price to book over here, 16% discount, right? But the problem is they don't even have an ICR because all the ones that have been losing money, they are not able to pay dividend for the past 1 year. So the dividend is 0. And at the same time, they have a very high gearing ratio. So will this REIT last through this cycle? We don't know. Okay. The last one is the 100% retail REIT. Okay. Although the dividend yield is 5.something% and also undervalued, but the gearing ratio is very high, and also interest cost is 6.something%. In ICR is only 1.7. So although it's undervalued, but this REIT can be very risky. Okay. So that's all for my sharing tonight. Hopefully, I can give you some peace when you come to your reinvesting and also know what are the direction you should take. So if you need any advice or you have any question, I will try to answer in this webinar. But if you need to approach me separately, this is a QR code. My contact is over here. Just scan it and you can contact me. All right, I will stop here and answer some of the questions.
Okay, thank you, Kenny. Thank you for your intensive sharing also. Yeah, so and also giving us the assurance that the interest rate hike in the past have not affected the REITs at all, so that we can navigate this year's interest rate hike in the REITs market with better peace of mind. So thank you for that. Right, and also I think the very important and interesting slide that personally I really like is the cycle of the COVID, where we are just off the best time to invest in REIT was during the COVID crash, but it was a lot of uncertainty. So those who are more gung-ho, who have stepped in during that time would have made gains during that time. But for those who did not, now is still not too late. So don't miss the train. Get yourself equipped either by learning yourself or getting the professional help from professionals like Kenny to help you to construct or even manage your REITs portfolio. So if you have questions for Kenny, please feel free to type into the chat box on the screen if you're using the desktop browser on the bottom right. If you're using a mobile, please scroll up or down and look for the text box. Okay, so let me see what are the questions there. Okay, the first questions come from Lionel, and Lionel is asking, why do the share prices of blue chip industrial REITs keep falling?
Okay, I think I just I touched a little bit in my presentation. 2 reasons. The first reason was all those blue chip. They normally in the cycle itself, they tends to move first. So in the 2020, basically all those big cap, Ascenders, MIT, MLT, Keppel DC, those were the best performer. They have already been overvalued. So during this rate hike itself, the fund manager basically they are doing some rebalancing because they have to take profit. At the same time, they're also included in a majority of the index. That's why when the yield spread is being compressed, they have to do some rebalancing. When they do a rebalancing, definitely all those big cap REIT you'll be hit first. So you can see very clearly that all those small cap REIT basically you don't see the severe drop in the share price, because small cap REIT have a much, either they are not in the index or they have a very, very minimum allocation in the index itself.
I see. Okay, great. Lionel, I hope that answers your question. Now, the next question comes from Joe. Joe is asking, from Lo. What do you think of MCT and MNAC's merger?
I will not comment on the individual REIT itself, but I just want to give you some pointer for you to start thinking about it. You have to focus on the objective, right? If your objective is invest in REIT so that long term the dividend yield up is going up, at the same time they can give you a very consistent dividend, at the same time also reduce the portfolio risk, right? If this is your objective, right, you need to look at this merger whether they serve your objective or not. So start with your objective in mind, because we are not trading the market. When we are investing in the REIT, we are really looking at the long-term growth in terms of the DPU. That is a key objective. So you always think of this perspective when you evaluate for any M&A. Okay, because there are a lot of M&A going on every day. Basically, everybody is just talking about the share price. It happens to Airlock and also ESR now. It's still a share price, right? MCT also talking about share price. Okay, so but for me, my objective is for long term. I'm looking at things differently. I don't bother too much about the share price. I focus on after the merger whether they can give me a much better so-called REIT in terms of the market size, in terms of liquidity, in terms of risk management. Are they really giving me that kind of perspective? If they are yes, then I support the merger.
I see. Okay, thank you for the comprehensive answer. Now, the next question comes from A-Scan. I think he's looking for resources to help him to shortlist or select REITs. So just now you showed your bubble chart and also the comparison table. Do they go to your website or blog to look for this information?
Yeah, they can go to my blog, my stock investing, right? You definitely can get some of the chart over there, because I have some bubble chart posted on my blog itself, and also you should be able to locate the REIT screener I use.
Yes. So A-Scan, I hope that answers your question. You can go to Kenny's blog, My Stocks Investing, that's with an S, .com. Okay, and look for the bubble charts and the table that he has shared. In addition, a little tip from me, I also use this website called sginvestor.io. They have a very comprehensive resources of analyst reports of all SGX counters, and they have a section for REITs, so you can go there as well. That's sginvestors with an s.io. Okay, so let me see. Last question would be from Yuan Tak. Yuan Tak is asking, hi Kenny, REITs issue private placement, preference shares, rights issues as part of equity fund raising. Now this typically dilutes the share price. Is REITs still a good long-term dividend income source for retiree investors like himself?
Okay, good question. So it depends on how you construct a REIT portfolio. If you are buying individual REIT, all this corporate action is part and parcel of the REIT management. You cannot run away from it, right? Because REIT has to distribute more than 90% of the taxable income to the shareholder. Basically, they don't hold any cash. If they really want to grow their portfolio, every time they have to raise funds from an investor to grow their portfolio. So if you have that concern, you may need to restructure your portfolio to the REIT managed account, or using unit trust, or using the ETF, right? So this one you eliminate the headache for you to really manage all this corporate action, because when they do this thing, especially on the on all those right issue, you have to subscribe. If you don't subscribe immediately, it's a share dilution, and also you suffer losses in your share price. You have to subscribe to it so that all in all, you are still okay. So I hope this answer your question, right? And also when they issue the right and also doing all this product placement, also pay attention to what is the objective. If they are issue all these additional shares just to grow a portfolio, that means in return you are able to get a higher dividend yield. At the same time, also can grow in the portfolio value. Then basically you should support all this kind of right issue. Okay, because when I meet one of the REIT manager itself, right, he also mentioned it's very, very important for the REIT manager continue to really recycle the portfolio, because some of the lease of the property is getting shorter and shorter. When the lease getting shorter and shorter, the NAV value will drop. So they have to sell those property with short leases, and they have to really move their portfolio to all those freehold. So always they are always doing all these things, and all this activity you really disturb an investor a lot. Okay, I totally understand your concern. So you may really need to start thinking using some other instrument if you really want to invest in it.
Right. Thank you, Kenny. And I have some questions here that are specific about specific REITs. So I know that, Kenny, you will not answer questions like this because this is under the advisory. So due to your MAS license, you cannot give advice publicly like that. So for those of you who have specific questions about specific REITs that you would like to ask Kenny, you can reach out to him using his contact QR code that he has put on the screen, or go to his blog, mystocksinvesting.com, and you will also be able to contact him there. So with that, we have come to the end of the sharing session today for the market outlook. So Kenny, thank you very much for your time. Do you have any last words with our attendees?
Last word, always plan your portfolio. I would really suggest, if you want to invest, always start with an objective in mind and plan your total portfolio. Don't go in a little bit here, a little bit there, because you confuse yourself. Okay, this is I did it wrongly last time until I become a licensed financial advisor, and also all those professionals really teach me to do a proper portfolio construction. So that after you build a proper portfolio with proper risk management inside your investment portfolio, you really can sleep well. So the sleep well factor is very, very important when it comes to investment. If you feel that you cannot sleep well, that means that your portfolio has something wrong, that you may need to manage it. All right.
Right. Cool. Thank you, Kenny. And with that, we'll call it a night. And thanks to almost 200 of you who are still with us, both inside the webinar room as well as watching us on YouTube live. And a very happy and prosperous Chinese New Year to you, which is next week happening in Singapore. And do remember to join the Telegram channels so that you can be kept posted of the upcoming events from all the respective supporters of OTCS. All right. So Kenny, 恭喜发财. I'll see you again very soon.
Okay, thank you. Bye bye.
Bye bye. And for all attendees, very good 2020 to you as well. And good night.